I am Jesse Livermore, and I turned $10,000 into $1.5 million by mastering what I call the waiting game. Most traders destroy themselves through impatience, but I learned early that the market rewards those who wait for the perfect moment to strike. My fortune wasn't built on constant activity. It was built on strategic patience. When I began trading, I made the same mistake most amateurs make: overtrading. I'd jump at every minor fluctuation, convinced each movement was significant. The market took my money again and again. It wasn't until I lost everything multiple times that I finally understood the power of waiting. Let me teach you my waiting game strategy. First, understand that the market moves in major trends that last months or years, not days. I made my millions by identifying these primary movements and riding them with size. In 1907, I watched as the market showed signs of weakness for weeks. While others were buying dips, I stood aside, patient, observing. When the panic finally hit, I was positioned perfectly short and made over $1 million in a single day. The secret is this: I don't trade 90% of the time. I sit, I watch, I wait. When the perfect setup appears, when price action, volume, market sentiment, and sector trends all align, only then do I commit significant capital. Most traders can't handle this discipline. They feel they must be active to justify their existence as traders. This psychological weakness is why they fail. My second principle: size matters only when you're certain. When I see the perfect setup, what I call my pivotal points, I trade with enormous size. In 1923, I identified a bull market in cotton, waited for my entry point, and committed heavily. My patience was rewarded with hundreds of thousands in profit. Had I scattered my capital across dozens of mediocre trades, I would have achieved mediocre results. My third rule of waiting: cut losses immediately, let profits run indefinitely. When I'm wrong, I exit without hesitation. But when I'm right, I let the market tell me when to exit. In 1929, I maintained my short positions for months as the market collapsed, turning my initial investment into millions. Most traders do the opposite. They cut profits quickly and let losses grow, hoping for recovery. The waiting game requires immense psychological strength. You'll feel the pressure to act when others are making money in a market you're avoiding. You'll question yourself during long periods of inactivity. This is where most traders break. I've trained myself to embrace these quiet periods, knowing they're when my edge is being built. Remember this: the big money is made in the big moves, and big moves require patience to identify and courage to exploit. My $10,000 to $1.5 million transformation didn't happen through frantic day trading. It happened through disciplined waiting followed by bold action. Master this balance, and you'll separate yourself from the amateurs who constantly feed the market with their impatience. The waiting game isn't just a strategy. It's a philosophy that applies to all aspects of trading. Wait for your moment, then strike with conviction. I am Jesse Livermore, known in my day as the Boy Plunger, and I learned the art of patience long before most traders even placed their first trade. At 14, I began my journey recording stock prices on the board at Payne Weber in Boston. While other boys my age were still in school, I was already studying the only textbook that truly matters in this business, the ticker tape. My first lesson in patience came early. I'd watch numbers dance across that board hour after hour, day after day. Most men would grow bored, their minds wandering to baseball scores or dinner plans. Not me. I saw patterns where others saw random figures. I developed what I call tape reading, the ability to sense the market's direction by observing price movements. This wasn't just looking at numbers. It was developing an intuition about the flow of money. Let me tell you something crucial about patience in trading. It's not about sitting idle. It's about waiting with purpose. When I was 15, I took my first plunge with a mere $5 in a bucket shop, a gambling parlor disguised as a brokerage. I didn't just throw my money at any stock. I waited until I saw a clear opportunity in Burlington stock. My patience paid off with a profit of $3.12, a fortune to me then. The bucket shops taught me discipline. These establishments weren't interested in your success. Quite the opposite. They made money when you lost, which meant I was playing against professionals designed to separate me from my money. I had to develop extraordinary patience just to survive. By 16, I had turned my initial stake into $1,000, equivalent to about $30,000 in today's money. How? Not by trading more, but by trading with precision and patience. I waited for the perfect moment when the odds tilted heavily in my favor. Most traders lose because they feel compelled to be in the market constantly. I never suffered from this disease. My early success came from a simple rule I still follow. Wait until the market confirms your judgment before entering a trade. The market will tell you when it's ready to move. Your job is to listen and act only when it speaks clearly. In those formative years, I developed another crucial habit. I kept detailed records of every trade. These weren't just numbers in a ledger. They were the story of my education. When I lost, which I certainly did, I studied those losses with the intensity of a scientist examining specimens under a microscope. Each failure contained the seeds of future success, but only if I had the patience to extract the lesson. By the time I was 20, I had been banned from most bucket shops in Boston, not because I cheated, but because I won too consistently. They couldn't beat me because I had developed something they couldn't counter, the patience to wait for the perfect opportunity and the discipline to act decisively when it arrived. The markets have changed dramatically since my early days, but this fundamental truth remains. Fortune favors the patient trader. The market will always offer opportunities to those disciplined enough to wait for them. This lesson cost me dearly to learn, but it's one I've never forgotten. Patience isn't just a virtue in trading. It's the foundation upon which all sustainable success is built. I am Jesse Livermore, the man who made and lost several fortunes in the early 20th century markets. The sitting tight principle is what made me millions and what cost me everything when I abandoned it. Let me teach you the most valuable lesson I ever learned. When I was just 15 years old, working at Payne Weber's Boston brokerage, I began to see patterns in the numbers flowing across the ticker tape. I started with just $5 in my pocket, trading in bucket shops before moving to legitimate brokerages. By 1907, I'd made my first million shorting the market during the panic, all by mastering one principle: sitting tight. Here's what sitting tight truly means. Once you've identified a major market movement and positioned yourself correctly, the real money comes from having the patience and conviction to hold your position. I don't mean stubbornness. I mean calculated patience based on market understanding. In 1907, I watched the market carefully for months. The signs of weakness were there: overextended credit, banking instability, and excessive speculation. When I finally shorted Union Pacific, I didn't take quick profits. I sat tight through the volatility, the newspaper headlines, the panic. My position grew from thousands to millions because I refused to be shaken out. The sitting tight principle requires 3 elements I developed over decades of trading. First, you must have absolute conviction in your position based on thorough analysis. I spent hours studying price movements, volume patterns, and economic conditions before taking major positions. Second, you must size your position appropriately so market fluctuations don't force you out prematurely. I never risked more than 10% of my capital on a single trade. Third, you must develop the emotional discipline to withstand the psychological warfare the market wages against you. In 1929, I made $100 million in the crash, equivalent to billions today, by sitting tight on my short positions while others panicked. I saw the excessive speculation, the dangerous margin levels, the disconnect between stock prices and economic reality. When the collapse came, I didn't rush to cover my shorts at the first drop. I sat tight until the major move had completed. The most painful lessons came when I abandoned my own principle. In 1908, I lost my entire fortune because I listened to outside opinions rather than trusting my own analysis. I got out of positions prematurely, doubting myself. I violated my sitting tight discipline and paid dearly for it. Remember this: the market is designed to shake out the impatient. The public buys at the top and sells at the bottom precisely because they cannot sit tight. They lack the conviction and discipline to hold positions through temporary adversity. My biggest trades, the ones that built my legend, weren't from frequent trading. They came from identifying major moves, positioning correctly, and then having the courage to sit tight until the move completed. When I followed this discipline, I made millions. When I abandoned it, I lost everything. This principle isn't just about holding, it's about recognizing when you're right and giving your position room to work. The market will test your conviction repeatedly. Your ability to sit tight when you're right is what separates legendary traders from the forgotten. I am Jesse Livermore, and I've made and lost more fortunes than most traders will ever see in their lifetimes. My greatest strength wasn't my ability to read ticker tape or analyze markets. It was mastering the battlefield of my own mind. The psychology of patience became my most powerful weapon, though it took me decades and several bankruptcies to truly understand it. When I began trading, I was like most of you, emotional, impulsive, desperate to act. I'd feel my heart race when a stock moved, my palms sweat when positions went against me. The market became a mirror reflecting all my fears and greed. I learned the hard way that my emotions were my greatest liability. I discovered that patience isn't passive. It's the most active discipline in trading. In 1907, during the panic, I watched others frantically selling while I calmly held my short positions. My body screamed to take profits, but I waited. That patience turned $250,000 into $3 million in a single day. The market rewards those who can sit still when everyone else is running. Let me share my psychological framework. First, I separated my identity from my trades. When I lost money, I wasn't a failure. The trade was. This distinction saved my sanity. I would tell myself, this position is wrong, not me. This mental separation allowed me to cut losses without emotional damage. Second, I developed what I call emotional checkpoints. Before every significant trade, I'd ask myself, am I entering this position because of research or reaction? If I couldn't articulate my thesis in simple terms, I wouldn't trade. Emotion clouds judgment, always. When cotton prices collapsed in 1919, I lost $5 million because I ignored my own system. I let pride override patience. Third, and this was crucial, I learned to embrace boredom. The most profitable periods of my career were when I did nothing. Absolutely nothing. In 1923, I sat for months watching, waiting. Most traders can't tolerate inactivity. They feel they must always be in the market. This compulsion to act is financial suicide. I made my largest profits during periods when I traded the least. My discipline was simple but brutal. I would only enter a position when all my criteria aligned perfectly. This meant sometimes waiting weeks or months for the right opportunity. During the 1929 crash, I waited until my indicators confirmed the downtrend before committing heavily to short positions. That patience made me $100 million when others lost everything. Remember this. The market doesn't care about your timeline. It moves on its own schedule. I've watched countless talented traders destroy themselves because they couldn't synchronize their emotional clocks with market timing. My greatest psychological tool was a trading journal, where I recorded not just my trades, but my emotions. When I felt the urge to deviate from my plan, I'd write it down instead of acting on it. This created the space between impulse and action where wisdom lives. Master your emotions, and you'll master the market. I've proven this through multiple market cycles, through booms and busts. The market will test your patience more than your intelligence. It will punish the impatient and reward those who can wait. This isn't philosophy. It's the mathematical reality of trading that I've lived. I am Jesse Livermore, the man who made and lost fortunes multiple times over. Many call me the greatest trader who ever lived, though I've tasted both spectacular victory and crushing defeat. What I'm about to share with you isn't theory. It's the hard-earned wisdom that allowed me to extract millions from the market when I was at my best. My journey began in the bucket shops of Boston when I was just 14 years old. I quit school and took a job posting stock quotes on a blackboard. Those bucket shops were nothing like today's regulated markets. They were essentially gambling dens where the house always won, except when they faced someone like me who could read the tape. I quickly discovered I had a gift for recognizing patterns in stock movements. By 15, I'd made my first $1,000, equivalent to over $30,000 today. The bucket shop operators eventually banned me from their establishments because I was winning too consistently. They couldn't afford me anymore. Let me tell you about patience, the cornerstone of my trading philosophy. I didn't develop this virtue naturally. I paid dearly for it. In my early years, I'd jump at opportunities, overtrade, and squander my capital on impulse. The market taught me discipline through repeated failure. My first lesson in patience came when I was wiped out completely. I had to borrow money just to eat. That experience burned into my soul, the understanding that preservation of capital must come before profits. I learned to wait, sometimes for weeks or months, until the perfect setup appeared. Here's what I discovered. The big money isn't made in the daily fluctuations. The real fortunes come from catching the major moves. When I finally grasped this, I developed my famous waiting strategy. I would sit with positions for months, sometimes years, riding the big trends that others missed because they were too busy chasing quick profits. In 1907, during the market panic, I made $3 million in a single day by shorting the market. That's over $80 million in today's money. How? Patience. I had been building my short position methodically, waiting for the inevitable crash that my analysis told me was coming. When others panicked, I executed calmly. My rule became simple. Only enter a trade when all factors align. If there's doubt, stay out. I would often say, there is a time to go long, a time to go short, and a time to go fishing. Most traders never master the go fishing part. The market will always be there. The opportunities never cease. Your job isn't to catch every move. It's to catch the right moves with sufficient size to make them count. I developed what I call the pivotal point strategy, identifying key price levels where the market reveals its hand. When stocks break through these levels with increasing volume, that's when I strike, not before. This approach saved me from countless premature entries that would have destroyed my capital. Remember this: the market doesn't care about your hopes, your needs, or your opinions. It only respects your discipline and patience. I made my greatest fortunes not by trading more, but by trading less, with larger size when conditions were perfect. Patience isn't just waiting. It's waiting with purpose, with analysis, with conviction. That's what transformed me from a bucket shop gambler into Wall Street legend. I am Jesse Livermore, and in 1907 I made one of my greatest fortunes during what history now calls the Panic of 1907. I turned $10,000 into $3 million by shorting the market with patience and precision. Let me teach you exactly how I did it, because the strategy I used then still works today. The seeds of my success were planted months before the crash. I noticed something most traders missed. The market's internal strength was deteriorating while prices still looked healthy on the surface. I saw fewer stocks making new highs while the indexes maintained their levels, a classic divergence signal I've always paid attention to. By March 1907, I had already established my short positions. Most people thought I was crazy. "Jesse, you're fighting the trend," they told me. But I wasn't guessing, I was observing. I watched the action of copper stocks, particularly amalgamated copper, which started weakening before the general market. In my years of trading, I found that copper often serves as the canary in the coal mine. My strategy was built on 3 principles that I've used throughout my career. First, I built my positions gradually. I didn't go all in at once. That's amateur behavior. I scaled into my shorts methodically, adding on each rally attempt. Second, I maintained iron discipline with my stops. Even though I was convinced of the coming crash, I protected myself in case I was wrong. Third, and most importantly, I had patience. I didn't try to catch the exact top. The market started breaking in earnest that October when the Knickerbocker Trust Company collapsed. Banking panic spread like wildfire. While others panicked, I remained calm. This wasn't luck. This was the scenario I had positioned myself for months earlier. As stocks plummeted, I didn't cover my shorts immediately. This is where most traders fail. They get greedy for the bottom just as they get greedy for the top. Instead, I watched for signs of capitulation. When I saw volumes explode and indiscriminate selling across all sectors, I knew the end was near. My most profitable trades came from shorting Union Pacific and Reading Railroad. These were market darlings that had been bid up to unsustainable levels. I targeted them specifically because the most loved stocks often fall the hardest. When Union Pacific dropped from 195 to 100, I covered most of my position. Not at the exact bottom, I never tried to catch that, but at a point where the risk-reward no longer favored my short. What separates my approach from others is that I don't fight the tape. I align myself with it. When I shorted in early 1907, I wasn't predicting the future. I was responding to what the market was already telling me through its deteriorating internals. The lesson I want you to take from my 1907 experience is this. Major market moves don't happen in an instant. They develop over time, giving you ample opportunity to position yourself if you're paying attention to the right signals. Patience in building positions, iron discipline with your risk management, and the courage to act on what you see rather than what others say. These are the traits that made me millions in 1907 and throughout my career. Remember, markets change, but human nature doesn't. The fear and greed that drove the 1907 panic are the same emotions driving markets today. I am Jesse Livermore, the man who made and lost several fortunes in the early 20th century markets. My name became legendary on Wall Street for taking $100 and turning it into over $100 million, and then losing it all more than once. Today, I'll share with you my 3-part patience formula that separated my greatest trades from my worst mistakes. When I was operating at my peak, patience was my greatest ally. Not technical analysis, not fundamental research. Pure, disciplined patience. Let me explain the formula I developed through decades of hard-won market experience. The first component is what I call the wait phase. I don't chase stocks or rush into positions based on tips or sudden market movements. Instead, I wait for what I call pivotal points, those critical moments when the market reveals its true intention. Most traders fail because they cannot sit quietly while opportunity develops. I've made millions by simply waiting for the market to confirm what I already suspected. In 1907, during the market panic, I waited patiently while others frantically sold. I observed the patterns, remained calm, and only when I saw a clear confirmation did I short Union Pacific and Reading Railroad. That patience netted me $3 million when most traders were wiped out. The market rewards those who can wait without anxiety. The second part of my formula is confirm. Once I identify a potential opportunity, I require the market to confirm my thesis before committing significant capital. This means I need to see the stock actually begin its anticipated movement. I don't try to catch the exact bottom or top. That's a fool's game. Instead, I wait for a confirmation that the trend has established itself. In 1923, I suspected steel stocks were ready to decline, but I didn't act on that suspicion alone. I waited until U.S. steel broke below a key support level and showed increasing downside momentum. Only then did I establish my position. The confirmation protected me from being early, which in trading is indistinguishable from being wrong. The third and final component is scale. Once the market confirms my thesis, I don't plunge in with my entire capital. I scale into positions, adding as the market continues to prove me right. This approach accomplishes 2 critical things. It reduces my risk if I'm wrong, and it maximizes my profits if I'm right. During the 1929 crash, I began shorting overvalued stocks in small positions. As each stock confirmed my bearish thesis by breaking down, I added to my positions. By the time the crash accelerated, I had built substantial positions that ultimately generated over $100 million in profits. Had I gone all in at once, I might have been shaken out during temporary rallies. The beauty of this three-part patience formula, wait, confirm, scale, is that it works in any market environment. It kept me solvent when I followed it and cost me fortunes when I abandoned it. The times I've lost millions were precisely when I violated these principles, letting emotion override discipline. Remember, the market will always be there. The big money is not made in the buying and selling, but in the waiting. Wait for the right moment. Confirm your thesis with market action, and scale into positions as the market proves you right. This is how I made my millions, and it's how you can preserve and grow your capital too. I am Jesse Livermore, and I've made and lost more fortunes than most traders will see in 10 lifetimes. When people ask me about my greatest challenge in the markets, they expect me to talk about chart patterns or economic indicators. The truth? My greatest battle was against myself, specifically against the crushing psychological weight of FOMO, the fear of missing out. I remember standing in my office in 1929, watching the ticker tape as stocks climbed to dizzying heights. Everyone around me was buying, celebrating their paper fortunes. The newspapers trumpeted new millionaires daily. My instincts screamed that this was unsustainable, but I felt that familiar tug. What if I'm wrong? What if I miss the greatest bull market in history? This psychological battle is what separates the amateur from the professional. I conquered my FOMO through a disciplined approach that I'll share with you now. First, I learned to recognize FOMO's physical symptoms in my own body. When I felt my heart racing as prices moved without me, when my palms sweated as I watched others profit while I stood aside, I knew FOMO had me in its grip. I trained myself to step back at precisely these moments. When you feel that urgent need to jump in, that's exactly when you should pause and breathe. Second, I developed my famous notebook system. I documented every trade, every emotion, every impulse. October 15th, 1907. Felt desperate to buy U.S. steel as it rallied. Resisted. Price collapsed 2 days later. These written records created an undeniable pattern. My FOMO impulses were consistently wrong. The data doesn't lie, and seeing my own psychological patterns documented broke their power over me. Third, I pre-committed to my trading rules. Before market open, I wrote my entry and exit points with clear reasoning. When FOMO struck during trading hours, I had only one question. Has anything about my original analysis changed? If not, I stood firm. This single discipline saved me millions. Fourth, I isolated myself from market noise. In 1907, I famously disconnected my ticker tape machine during critical decision periods. Today, you might turn off CNBC and Twitter. The chorus of voices, especially during major market moves, feeds FOMO like nothing else. Fifth, I reframe missed opportunities as the cost of doing business. The market offers infinite opportunities, but surviving long enough to capitalize on them requires missing most of them. I told myself, there's always another train coming into the station. During the 1929 crash, my FOMO discipline paid off spectacularly. While others bought the dips all the way down, desperately trying to recapture lost gains, I remained patient. I shorted at precise moments when my rules, not my emotions, dictated. That psychological discipline turned $3 million into $100 million. Remember this, The market will always tempt you with what others are making, but wealth isn't built on what you make in your best trades. It's preserved by what you don't lose to impulsive, FOMO-driven decisions. Master your psychology, and you've mastered the hardest part of trading. Everything else is just arithmetic. I am Jesse Livermore, and patience has made me millions when others lost everything. The 1907 market crash wasn't a disaster for me. It was the opportunity I'd been waiting for. And I walked away with $3 million when most traders were ruined. I'll teach you my waiting game strategy that turned market panic into profit. My success in 1907 wasn't luck. It was calculated patience. For months before the crash, I observed the market's deteriorating condition. While others were still buying, I was preparing. The signs were there: tightening credit, banking instability, and excessive speculation. I didn't need to predict the exact date. I only needed to recognize the inevitable direction. I developed what I call my waiting game, a discipline few traders ever master. When I sensed weakness in the market, I didn't rush to short stocks. Instead, I methodically built small test positions, confirming my thesis before committing significant capital. This is crucial. I tested the market's character before betting heavily. My rule was simple. I wait until the market confirms my suspicions. In early 1907, I placed small short positions on Union Pacific and other railroads. When these positions showed profit, I gradually increased my commitment. By October, when panic erupted, I was already positioned. I've learned that timing isn't about being first. It's about being right. Most traders lose fortunes trying to catch the exact top or bottom. I don't care about catching the first 20% of a move or missing the last 20%. I focus on capturing the middle 60% where the real money is made with minimal risk. During the 1907 crash, I didn't short at the absolute top. I waited for confirmation, then pyramided my positions as the market fell. Each winning trade gave me more capital to deploy into the next opportunity. This is how I turned an initial stake into millions, not by gambling everything on one prediction, but through progressive position building. The waiting game requires emotional control that most traders lack. When I saw the panic beginning, I didn't become emotional or rush my execution. I stuck to my plan, methodically increasing my positions as each price level broke. This disciplined approach is why I prospered while others jumped from windows. Remember this: the market will always give you opportunities if you have the patience to wait for them. Most traders fail because they force trades out of boredom or fear of missing out. I've made my greatest profits by waiting for the perfect setup when the odds are overwhelmingly in my favor. My 1907 success came from recognizing that markets move in waves, not straight lines. I didn't need to predict the panic's exact timing. I simply positioned myself to capitalize on the inevitable. The market always telegraphs its intentions if you know how to read the tape. The waiting game isn't passive. It's active preparation. While waiting, I studied market conditions, built my trading plan, and preserved capital. When opportunity arrived, I was mentally and financially prepared to act with conviction. Master patience, and you master the market. This lesson has served me through every major market move of my career. The big money isn't in the buying and selling. It's in the waiting. I am Jesse Livermore. The market destroyed me 4 times before I truly understood what I was up against. Not stocks, not trends, but myself. My own psychology was the enemy I had to master before I could master the markets. When I began trading in bucket shops at 14, I thought success was about reading ticker tape faster than others. I was wrong. The psychological edge I eventually developed is what separated me from the amateurs who consistently lose their capital. I discovered that market timing isn't about predicting the future. It's about disciplined patience. I wait for the market to confirm my thesis before I commit significant capital. This patience has saved me millions. When the 1907 panic hit, I didn't act on a hunch. I observed the weakness in Union Pacific for weeks, testing small positions until the market confirmed what I suspected. Only then did I commit fully to my short position, eventually netting me $3 million when others lost everything. Let me share my psychological framework. First, I never allow hope to influence my trading decisions. Hope is a trader's worst enemy. When a position moves against me, I don't hope it recovers. I exit. Period. The market doesn't care about my feelings or my financial needs. Second, I maintain absolute emotional neutrality. During the 1929 crash, while others panicked, I methodically executed my strategy. I shorted the market with ice in my veins because I had already tested my thesis with smaller positions. My emotional detachment allowed me to profit 100 millions when others jumped from windows. Third, I've learned to sit tight when I'm right. Most traders take profits too quickly. They fear losing what they've gained. I've trained myself to ride profitable positions until the market tells me the trend has changed. This psychological discipline is how I turned $10,000 into $10 million during the 1907 crash. My timing methodology isn't complicated. It's psychologically difficult. I look for pivotal points where market sentiment shifts. I've trained myself to recognize these moments not through complex formulas, but through price action. When a stock doesn't respond to bad news as expected, I pay attention. When a sector continues rising despite negative economic indicators, I take notice. The hardest psychological lesson I have learned is that being too early is indistinguishable from being wrong. I've lost millions by being right about direction, but wrong about timing. Now, I wait for confirmation. I let the market prove my thesis before committing significant capital. My greatest psychological edge comes from understanding that markets are driven by human emotions, fear and greed, which repeat in predictable patterns. I've trained myself to recognize these patterns and position myself accordingly. Remember this: the market will teach you expensive lessons if you allow your psychology to control your trading. Master your mind first, and the market will follow. I've made and lost several fortunes because I occasionally forgot this fundamental truth. When I stayed true to my psychological discipline, I became the greatest trader of my era. When I abandoned it, I lost everything. The choice is yours. I am Jesse Livermore, the man who made and lost several fortunes in the early 20th century markets. What I'm about to teach you about strategic patience isn't theory. It's the exact methodology that helped me accumulate over $100 million in today's dollars and earn me the title, the Great Bear of Wall Street. My approach isn't for the faint of heart, but for those who understand that true wealth comes from waiting for the perfect moment to strike. The cornerstone of my $100 million strategy was something most traders never develop: extraordinary patience. I didn't make my millions by trading every day or chasing every market movement. I made my fortune by waiting, sometimes for months, until the perfect setup appeared, then striking with absolute conviction. Let me be clear about my methodology. When I saw a major market move developing, I would first take a small position, what I called my testing line. This initial position wasn't about making money. It was my reconnaissance. If the market confirmed my thesis, I would add to my position aggressively. If it didn't, I would exit immediately with a small loss. This approach protected me from catastrophic losses while allowing me to capitalize on major moves. My greatest triumph came in 1929. While others were blindly buying into market euphoria, I saw the signs of the coming crash. I waited patiently as the market reached unsustainable heights. When my indicators confirmed my suspicions, I began establishing massive short positions. When the crash finally came, I made approximately $100 million in today's currency in a matter of days. This wasn't luck. It was the culmination of patience and precise timing. The market gives its money most generously to those who wait for the fat pitch. I didn't swing at every opportunity. I waited for the ones where the odds were overwhelmingly in my favor. Most traders lose because they feel compelled to be in the market constantly. I made my millions by sometimes doing nothing for weeks or months until the perfect opportunity presented itself. My strategic patience had three components. First, I identified the primary trend of the market. Second, I waited for a significant retracement against that trend. Third, I entered only when the market resumed its primary direction. This simple framework kept me from fighting the tide and allowed me to enter positions with minimal risk. Remember this. The market will test your patience more than your intelligence. I've seen brilliant men go broke because they couldn't wait. The hardest thing I ever learned was to sit tight when I had a strong position. As I famously said, it was never my thinking that made the big money for me. It was always my sitting. The market rewards those who can endure the psychological torture of waiting. My $100 million strategy wasn't built on complex formulas or insider information. It was built on the ability to wait until the odds were so heavily stacked in my favor that success became almost inevitable. Master this patience, and you'll separate yourself from the amateurs who constantly chase the market's every move. I am Jesse Livermore, and patience has been my greatest ally and my harshest teacher throughout my trading career. When I look at today's markets, with their high-frequency algorithms and instant information flows, I see traders making the same fundamental mistakes I made a century ago. The technology has changed, but human psychology remains constant. Let me share how my patience principle applies even more critically in today's frenetic markets. I learned through devastating losses that waiting for the perfect setup is worth more than a dozen mediocre trades. In 1907, when I made my first million during the panic, it wasn't from frantic trading. It was from positioning myself patiently beforehand and then having the discipline to hold my shorts. Today's traders face even greater temptations to overreact. Your smartphones buzz with alerts. Your screens flash with opportunities, and social media bombards you with can't-miss setups. This environment is designed to destroy patience. I recognize it because I battled the same impulses with ticker tape. My modern application of patience begins with position sizing. I never risk more than 10% of my capital on a single idea. And I recommend you consider even more conservative limits in today's volatile markets. When I traded cotton in 1919, I violated this principle and nearly destroyed myself financially. The market can stay irrational longer than you can stay solvent. I learned this through painful personal experience. I've always maintained trading journals, and this practice becomes even more valuable with modern technology. Document not just your trades, but your emotional state when making them. I discovered patterns in my own behavior that were invisible until I reviewed my notes. Your digital journals can include screenshots, market conditions, and psychological notes that would have been invaluable to me in my era. The true test of patience comes during drawdowns. In 1929, before the crash, I saw the signs of market weakness, but moved too early several times. Each premature position cost me dearly. I eventually timed it right and made $100 million shorting the market, but only after painful lessons in waiting for confirmation. For today's traders, I recommend creating a personal patience protocol, specific conditions that must be met before entering a position. Mine included price action, volume confirmation, and sector behavior alignment. Your protocol might incorporate modern indicators, but the principle remains. Wait until all your conditions align before acting. Remember that patience applies equally to exits. I've lost millions by exiting and winning positions too soon. The big money is made in the sitting, not the thinking or the trading. When I caught major market moves, it was because I let my winners run with iron discipline. My final insight on patience is counterintuitive. Sometimes the most patient action is a quick exit when you're wrong. I learned to recognize my mistakes quickly and exit without hesitation. This preserved my capital for the truly significant opportunities that required patient waiting. In today's markets, this means having preset stop losses and honoring them religiously, something I wish I had implemented more consistently in my own trading. I am Jesse Livermore, and patience is what separated me from the amateurs who came and went like seasons on Wall Street. When I made my fortune of over $100 million in 1929 by shorting the market before the Great Crash, it wasn't luck. It was the culmination of decades learning to wait for the perfect moment to strike. Most traders lose because they can't sit still. I learned this lesson the hard way, blowing up my account multiple times before I finally understood. The market rewards patience above all else. When I was young and foolish, I'd jump at every ticker movement, convinced I was missing opportunities. Each impulsive trade left me poorer and more frustrated. Let me teach you what took me years to learn. The market will always be there tomorrow. I developed what I call my pivotal point strategy, identifying key price levels where the market reveals its true intentions. But finding these points means nothing if you lack the patience to wait for them. In 1907, I watched the market carefully as panic spread. While others frantically sold or bought on rumors, I waited. I observed. I let the market tell me its story through price action. When I finally saw my signal, a clear breakdown below support after several failed rallies, I committed heavily to my short position. The result? I walked away with $3 million while others lost everything. I've identified 3 principles of patience that transformed my trading. First, I wait for a confirmation, not anticipation. Amateurs try to predict. I react to what is actually happening. When the 1929 crash was approaching, I didn't short based on a hunch. I waited until the market showed weakness, confirmed by declining volume on rallies. and increasing volume on sell-offs. Only then did I commit my capital. Second, I sized positions according to conviction. Patience applies not just to entry timing, but position sizing. When my analysis is strong and confirmation clear, I trade big. When uncertain, I trade small or not at all. In 1923, I spotted a pattern in cotton that was so clear, so perfect, I committed nearly everything I had. My patience in waiting for that specific setup yielded millions. Third, I practiced patience after entry. The hardest skill is sitting tight when you're right. Most traders take quick profits, sabotaging potentially massive gains. When I shorted steel in 1920, I held my position for months while others jumped in and out. My patience turned a good trade into a fortune. Remember this: the market is designed to separate impatient traders from their money. I've made over $100 million multiple times, but I've also lost it all more than once. The difference between my successes and failures: in my winning periods, I had the patience to wait for perfect setups and let my winners run. There's a famous quote attributed to me: "It never was my thinking that made big money for me. It was always my sitting." This remains the most valuable lesson I can teach you. The ability to do nothing, absolutely nothing, until the right opportunity presents itself is worth more than all the market knowledge in the world. Master patience, and you master trading.